So the session is not yet live on custom live streaming
It's
services.
done. It's done. It's done. It's done. It's
It
coming.
started?
Yes, it started. It
Fantastic.
started. Sachin,
Yes, sir.
who is starting?
Rahul, how many students are there in our Vikasa,
Yes,
Dhani
yes.
Vikasa?
How many students? It's
How
more than
many?
10,000, sir.
Oh, okay. Oh, we are talking only of Thane Vikasa, correct?
Yes, Thane.
Oh, large population.
Large population, sir.
So, hello everyone. A very good morning to one and all present over here. My name is Shivam Sharma, and today we have a very amazing session on international taxation by CA Rajesh Athavale sir. And before the session commences, I would like to request CA Rahul Gharat sir to share a few words of wisdom as a Vikasa chairman. Sir, over to you.
Yes, so I should be saying today onwards it is ex-Vikasa chairman. So it was a joyous journey till date, and how the 1 year passed was really mesmerizing one. Though it was a pandemic, we all tried to manage umpteen things and programs what we can manage day on day out. I should say that the team worked for you all guys, and it is heartfelt that next year I couldn't just be as weak as a chairman. Though what see that whenever the team decides, we have to go accordingly. So the new chairman Rajesh Sharma, he will be your Vikasa chairman, heading for you students. He's nice fellow. You will again enjoy like the way I have you enjoyed with me. First, for like to take few minutes, Rajesh sir, if you don't mind, just
Yeah,
say
please,
that
please.
just this is my last day. Just
Please,
few
please,
minutes, I will
please.
just ask of viewers to of the session. Okay.
Please.
First, I would like to thank my team, Smriti, who is a vice chairman of Vikasa, for leading the team. Then Sanika, our secretary. Then Hital, our treasurer, means, and then going ahead, Bhivan, Pranav, Sachin Mishra, Saili, Shivam, Shrutika, all these people, literally, I should tell that they have worked for you guys for the whole year and try to give you as many things of session, good sessions, various type of programs in different manners. We just planned it out. At the same time, I would like to thank our managing committee members, Yogesh Prasadesh sir, who was our backbone every time for every programs. Then I would like to even thank our committee member Chetan Chadwa sir, who was the brain Amit Shah of we always call him for every small different events we need to arrange. He used to give us a good different fellow, and really we enjoyed each and every person in our charter talks. Different sort of things and people used to come on our YouTube channel and platform, Thane Vikasa. And Thane Vikasa channel, I should be saying, it started on 5th of May, right, Shivam?
15th of May, sir.
15th of May, and today it is almost 1000 plus subscriber. Thank you for all your supports that you have given so far. It is just heading and going great. But still, I should be saying that when we analyze the reports of Thane Vikasa, still there is only 25% subscription for any of the programs what we do. Then see, after 25% subscription only, we are having 1000 subscriber plus. If 75% people started subscribing, we can thoroughly attain a good numbers. So I request you everyone that please subscribe to channel whenever you are in any of the programs, any point of time, so that just we will try to attain miles in our future. Then this is the last program, but not the last program of Thane Vikasa. Thane Vikasa will be again, it will be rocking even and even though award was not granted. See, award is immaterial. Rather, it is just not material, I should be saying. What efforts my team has put for all you guys is seriously hats off. So I should just respect my team that probably something we were missing, I should be saying that that's the reason awards were not awarded to Thane Vikasa. Then going further, no words left rather now that I should say that I should try to just sum up myself so that we can enjoy our session of Rajesh Athavale sir. And friends, sir is very great in international and transfer pricing. Do enjoy his session because the way he speaks is very lucid, and even a boring session is so interesting that you will never feel so that you need to just get up from your seats when his session starts. This is his qualities. Okay, so please enjoy it thoroughly and see what international taxation is about, how opportunities we have in international taxation. Okay, so that you can just know whether we can go into this international taxation or not. Okay, thank you, Shivam. Thank you all my team for helping and doing a great success in Thane Vikasa. Thank you.
So much. Thank you so much, sir. So thank you so much, Rahul sir, for such a heartfelt message. And Rajesh sir, over to you. The session is all yours.
Good morning, everyone. First of all, I would like to thank Rahul for giving me this opportunity to, make the presentation on this important or new emerging topic, basically international taxation. As you're aware that since 1991, when Manmohan Singh was a finance minister, he opened up the economy with because that point of time the foreign currency reserve was almost we were on the bankruptcy mode actually. That point of time he opened up the economy, and because of that initiatives taken by him, lot of foreign direct investment came into India. And from that
Sorry I'm interrupting. Friends, you are able to hear sir's voice because I am getting echo. So I thought I'll just confirm it out whether all
So
others
we're
are
able to hear it properly.
properly.
We're able to
Fine,
hear
sir.
it properly.
Go ahead, sir. Go ahead, sir.
Okay.
Sorry,
Okay.
sorry.
No issue. So since 1991, what I was saying that the Indian economy has opened up, and most of you will find that multinationals started making investment in India. Similarly, if you find of late, our Indian multinational also started making investment outside India, and India has considered one of the the BPO the location best preferred location in India because of our technical skill, because of our literature. This thing is also very good. And from that perspective, they find that low cost labor, technical this thing, and also the English fluent speaking class of people are there in India. And that's why you must have seen that most of the MNCs have set up offices, subsidiaries, joint ventures, branch offices, liaison office in India because of the demography of our the India and the large population. So that we have large base customer base is also there, and that also probably must have attracted the foreign multinational company to make investment in India. And of late, you must have seen that Indian multinationals are also going abroad and making investment. And that's why you will find that the importance of the international taxation is very important at this juncture. From that perspective, we need to see, because most of the audience today are the students who are appearing. Basically, this international taxation, I've been told that is a subject in the final course of the charter accountant course. And from that perspective, we need to see, because this is a ocean. International taxation is the ocean basically. But I'm going to touch upon or I can give a glance over, the overview of the international taxation, because if you go in each aspects of the international taxation, it will be have a one topic will end up spending more than 2 hours. So I'm going to summarize in the today, and my focus is that I will try to, because attention plan of the students are very, minimum, and that's why I want to make this session interesting. Want to make this presentation only for 1.5 hours. These presentations include certain case studies are also, which you will get some flavor that what happened actually in the international taxation. I have included certain case laws also, so that you will get some practical tips out of that. And I understand that for May 21 and November 21, the relevant assessment year for income tax is 21-22. And therefore, I prepared my slides in a such a way that most of the amendment which are applicable from 21-22 have been included. I will just share my screen. I believe that everybody can see my presentation slides. My presentation slides are visible. Hello. Hello. Presentation slides are visible.
Yes, sir, it is visible.
Okay, thanks. So these are the basically topics I'm going to cover, and it may happen that certain topics which I want to give more thrust but may not be able to go each and every line or slide. But considering the fact that I will going to basically complete in 1.5 hours this presentation. So today this presentation we are going to discuss about taxation based scope of total income, non-resident, NRIs, residential status. I think this is very important with some case studies. Certain presumptive taxation for the foreign non-resident, income deemed to accrue arise in India. I think this is the heart. This is the heart of our Income Tax Act, which deals with, what are the income in the hands of non-resident is taxable as deemed to accrue arise in India. Then certain importance of the topics are the double tax avoidance agreement, the base erosion profit shifting. This is a new concept is evolved by the G20 country along with the OECD. So we are going to touch base upon certain the aspects of that BEPS. And of course, there are certain exemptions, concession rate of tax, and special regime for the non-resident Indian. So we are going to touch upon this international tax today in these various slides. So let's start with what do you mean by the taxation base. Now you will find that under the international taxation, first we need to understand what are the basic provisions of the Income Tax Act. You cannot be a master of the international taxation without a master of the domestic tax, and therefore the domestic tax important sections are Section 6, Section 4, Section 5, Section 9, Section 90, Section 115, and all series of the non-resident taxation. I think this is a very important and fundamental aspects one need to see before you start practicing the international taxation. And you will find globally their taxation of cross-border transaction happen, and you will find there's a tussle, always tussle between there are two countries are involved. One is a residence-based country and the other one is a source-based country. Residence means the taxation will be based on residence, domicile, place of incorporation, or place of effective management. I think that is very important, that if I'm a tax resident of India, so my taxation in India will be based on the residence-based taxation. Now, I may have income from India or from outside India. Suppose I have income from USA. So wherever income is arising in that country, those taxation will be governed by the source-based taxation. So each country will have the two types of income. One will be taxed based on the residence of that taxpayer, and the second taxation will be based on where the income is generated. So therefore, you will find that I am an Indian resident because I am domiciled resident of India. The Indian tax authorities will have first right to tax me because of my residence status. Now what is happening is that, as you are aware, I am going to touch upon in the next slides on section 5 and 6, where I define what you mean by scope of income. So since I am a resident of India, my global income will be liable to tax because of my residency test. But suppose I have income from USA. USA or tax authority also has the right to tax me based on the source regulation. And say, therefore, what is happening that I end up in paying taxes in USA, also in India. So therefore, you will find there is always tussle between the resident country and the source country, how to share the tax of a particular transaction. And from that perspective, we need to understand what you mean by taxation based. So taxation based, residence based taxation is based on residence, domicile, place of incorporation. The now new concept has come, place of effective management. We call as a poem. And that is very important because regardless of source of income by any part of the world, the tax has to be paid wherever that person is a resident of that country. And therefore, and this concept you will find based mainly in the developed countries. Whereas the source-based taxation, basically taxation will be based on the source of income, where the source is generated, where the income is generated, that country will have the power to tax me, regardless of the person who is earning this income. He may be located or he may be resident of any country. Now here, this source-based taxation is concept in the income tax law of most of the developing countries. And why I want to make thrust upon developed countries and developing country is important, because developed countries always, has a cash reach or their economy is very strong. And you will find that most of the developed countries, where developing countries importing technology know-how from this developed country. And therefore, developed country want to protect their tax base, and they always emphasize while negotiating the tax between the developing country is that the first right of tax has to be in the residence country. They are very adamant from the negotiation perspective because of their technology. They have cash, this thing, very strong technology they have. They have the cash reach, the economy is very strong, and therefore they try to negotiate the tax treaty in such a way that whatever the income earned by the residents of the developed country will always tax in the developed country. But at the same time, the source country also negotiate and say that, okay, it will be taxable, but certain portion will be liable to tax in the source country, because developing country, basically what they are trying to say, yes, we are in need of technology, we are in need of sources, manpower, but at the same time, the intellectual manpower basically, but at the same time, the developing country should not want to lose any money which the foreign company earn in the source country, and therefore you will find there is always tussle between the developed country and the developing country. And therefore, the scope of total income is very important to understand the taxation of a foreign company. As you are aware, Section 4 is a charging section, and Section 5 outline the scope of total income for various categories of person depending upon their residential status. Section 5(1), which talks about taxable income of resident. So if I'm a resident of India, my worldwide income is taxable. So whatever the income received in India, whatever income, suppose if I received any income outside India, that is also liable to tax because I'm a resident of India. So Section 5(1), wherever it talks about that taxable income of resident, the worldwide income is taxable. As far as the non-resident is concerned, Section 5(2) is very important. Taxable income of non-resident include income received or deemed to be received in India. So it is possible that Indian person, he is a resident of India providing services outside India. When he get his fees in convertible foreign exchange, that is considered he is receiving the income in India. Okay, but wherever is a non-resident person who is earning from income from India, he will get either income in his home country outside India, or he will get the income in India. Suppose he receive the income outside India, yes, it is possible to argue that that income should not be liable to tax in India. But if the income received in India, then in that case, the income always liable to tax. So wherever the foreign residents are receiving, non-resident receiving any income in India, on receipt basis, it will be always taxable, irrespective of his physical state, irrespective of his incorporation, irrespective of his domicile. And therefore, this has to be keep in mind, because normally the professionals or even the students, sometimes that because he is a non-resident, nothing will be taxable in India. It is not that. So we require to see Section 5(2). So income received, income deemed to be received in India. Now, for income deemed to be received, and we can touch upon income which accrues or deemed to accrue or arise in India. I think this is a very important, wherever you will find that although the non-resident has carried out services outside India, but since the services has been utilized in India, or the payment from these services has been received from India, the Income Tax Act basically go extraterritorial operation, and therefore you will find that those non-resident will also be liable to tax based on the concept of accrue arise in India or concept of the deemed to accrue arise in India. And therefore the Section 9, which is nothing but the extension of Section 5(2), is very important. So Section 9 lists down which are the income are deemed to accrue or arise in India, and we are going to touch upon certain aspects of the income also which qualify under Section 9. So this is the table format, box format which I have prepared. Similar, the first slide which I have shown to you, this in the box format, you will find that if I am a resident but ordinary resident, my global income will be taxable. If I am a resident but not ordinary resident, then my worldwide income will be taxable except income or accruing or arising outside India. So we are going to touch upon those aspects. And in the case of non-resident, the income which is received, accrued or arisen, or deemed to be received or accrued or arisen in India will only be liable to tax. So what if the non-resident is earning any income from his activity outside India, that income will never be liable to tax in India. Whatever the income he earn or generate from India, only on those income, the Indian tax authority has a right to tax. So that is called a source-based taxation. We are going to touch upon certain these definitions, and as you are aware that Section 2(30) define a non-resident means a person who is not a resident, and includes a person who is a resident but ordinary resident but not ordinary resident for the purpose of Section 92. It talks about transfer pricing. Section 93, certain tax avoidance transaction, and Section 168 is like an agency transaction. So from that perspective, we need to see who are the non-resident, who are a resident but ordinary resident, and therefore from this definition you will find that there is always difference between non-resident and the resident. Now in the resident category you will find two types of person, resident and ordinary resident, and resident but non-resident. But under the non-resident basically, but only for the limited purpose, section 92, section 93 and section 168 purpose. I think this is a very important aspect that question may come, or MCQ question may come on that point, that whether resident but not resident regarded as a non-resident or not. So you need to be very careful in understanding what are the tax implications. Section 115C talks about, we have another category, non-resident Indian. Now non-resident means non-resident, and the other one is a non-resident Indian means an individual who being a citizen of India or a person of Indian origin. Now citizen of India means he has a valid passport of India, and person of Indian origin may include he was once upon a time a resident, having a passport, but he has now migrated, he has given up the citizenship, he born and brought up in India, or his parents, grandparents are born and brought up in India. So those type of basically persons are regarded as a person of the Indian origin. A person shall be deemed to be the Indian origin if he is either parents or the grandparent was born in undivided India. Now, Indian citizen who stays abroad for employment or for carrying out a business or vocation or any other purpose or circumstances, including indefinite period of stay. I think this is an important point, because if you see the definition of non-resident as per the Income Tax Act, there is a slight difference if you compare that definition under the Foreign Exchange Management Act. Now under the Indian Act, you will find that residential status of that person will be determined based on the physical stay. And we are going to touch upon that from assessment year 21-22, not only the physical stay, but citizenship of that person also a determining factor for residency test. But when it comes to the Foreign Exchange Management Act, not only the physical stay criteria you have to fulfill, but also you require to see, that what is the intention of that person to stay for indefinite period, definite period. Depending upon that factor, the residency status will be determined under the Foreign Exchange Management Act. Now residential status, we discussed resident and ordinary resident, resident but not resident, and a not resident. Now determining factor is, as I mentioned, that individual physical presence is very important. We are going to touch upon the next slides. Couple of case studies also are taken, and the new concept has come in the Income Tax Act based on the citizenship. Whether Indian citizen, but he is working abroad, he has not given up the citizenship India, still that person could be regarded as a resident with effect from assessment year 21-22. As far as the HUF, partnership firm, LLP, AOP, others, the determining factor would be control and management of its affairs. Now, even for HUF and partnership firm, if the entire control and management of its affair is outside India, then only those assessing would be regarded as a non-resident. But if the control and management is partly in India, partly outside India, in those cases, HUF, partnership firm, AOP would be still regarded as a resident of India. So I think this is very important, and I want to make this distinction of the control and management of affairs with this category of the person vis-a-vis the company person. So company, you will find that company will be regarded as a resident if that company is incorporated in India. And the second important thing is that or place of effective management of that company is in India, is wholly in India. I think you will find that two years back, this new concept has come, place of effective management in India. Prior to that, the concept was control and management of its affairs. If control and management of its affairs entirely in India during the year, I'm talking about prior to 2 years back, this place of effective management in India is substituted for control and management of its affairs. So for HUF, firm, AOP, control and management is partly in India, partly outside India. So the status would be resident. But for the company, 2 years back, if the control and management is partly in India and partly outside India, it won't be regarded as a resident of India. It was that control and management of its affairs in the case of company SSE, if it is wholly in India, then only those cases, those company would be regarded as a resident, the resident of India. But 2 years back, the control and management basically concept has been substituted by place of effective management. We are going to touch upon that also. So if you fulfill, and these are the important determining factor we need to consider while determining the residential status. Individual, you will find this is important, the slides, and for determining and this slide was valid till 2021 assessment year. We are going to touch upon what are the amendment happened for assessment year 21-22. The section basically 6.1, which deals with basically what do you mean by the individual. As you are aware that 2 tests has to be satisfied for becoming a resident, that the person, individual, has to be in India for more 182 days or more in the previous year. If he is not spending more than 182 days, then we have second test. This is an alternative test basically. These are basically not a cumulative test. This is an exclusively distinct test is there. That person has to be in India in the previous year 60 days or more, or 365 days in preceding 4 years. So if he doesn't fulfill the first condition of 182 days, then we need to come back to the second test of that he should be in India for minimum 60 days in that previous year, and cumulatively he has to fulfill the condition that he has to be in resident of India in 365 days in last 4 years. So for the 182 days, if you satisfy the condition, you will become a resident. But if you don't satisfy and your stay in India is between 60 or 182 days in the previous year, but also you have been staying in India 365 days in out of 4 years, if you satisfy this condition, then you will become a resident. Now there is a condition for that 60 days is that if a person, citizen of India, goes abroad for the purpose of employment, or he is the member of the crew of the Indian ship, in those cases the 60 days has been basically expanded till 182 days. So if the person of Indian citizen going abroad for the purpose of employment, vocation, or he is the member of the crew of Indian ship, in those cases the previous year stay has to be 182 days or more. Only in those cases, those SSE would be regarded as a resident of India. So there is they have given the basically the relaxation that instead of 60 days previous year, we should consider 182 days. And the second condition, now this first condition in the explanation to section 6.1 is that the being a citizen of India living abroad for the purpose of employment. In the explanation, second category, they said that in which cases 60 days has been expanded to 182 days is that the person has to be citizen of India or a person of Indian origin, and he comes on a visit to India. In those cases, the 60 days will be substituted by the 182 days. Now, from assessment year 21-22, the new criteria has set up that person who is a citizen of India or a person of Indian origin whose income in India is more than 15 lakhs. In those cases, the 60 days will be extended up to 120 days and not 182 days. So therefore, we need to be very careful while determining the residential status of that person, specifically for assessment year 21-22. So if you have the SSE who is basically Indian citizen or who is basically the person of Indian origin come in India on a visit, That point of time, we need to be very careful. In those cases, the 60 days, 182 days relaxation period will not be applicable. 122 days if he has an income in India more than 15 lakh. But suppose he has an income less than 15 lakhs, then I'm not bothered about 120 days. So we need to be very careful in understanding where the number of days will be applicable in case of the Indian origin person or citizen of India. If he fulfills this condition, then he will become non-resident, he will become resident. If he doesn't fulfill the condition, he will become a non-resident. Now under the resident category also you will find, before that we go to the resident category, we need to understand what are the basically the further criteria. Now this would be regarded as a resident. Now resident also you will find that two types of resident are there. Resident but ordinary resident and resident but not ordinary resident. Resident but ordinary resident means he has been staying in India or he is a resident in India in 9 out of 10 previous years, or he has been staying in India more than 729 out of 7 years. Those SSC will be regarded as a resident of India. But non-resident, if that person is a non-resident in 9 out of 10 years or less than 729 out of 7 years, those as resident will be classified as a resident but not ordinary resident. If he doesn't fulfill this condition, he will be regarded as a resident but ordinary resident. So we need to understand that from assessment at 21-22, you will find the new types of basically the determining factor for the resident. Now, the new concept we have brought on the statute, not on the statute, but by way of the memorandum understanding explaining the Finance Act 2020 subject is a stateless person. And you will find that Finance Act 2020 has reduced the period of visit for the citizen of India, person of Indian origin, having total income in India. I'm saying in India, other than income from other sources exceeding 15 lakhs, those SSC will be for the physical calculation, physical stay calculation purpose. The 120 days would be considered from assessment at 21-22. Now, this is a stateless person. This is a new, basically, in explanation 1A, section 1A, subsection 1A to section 6 has been inserted by the Finance Act, which provide, now this has to be very important. This talking about a person, an individual being a citizen of India. I think this is very important. They provide that Indian citizen who is not liable to tax in any other country by reason of his residence, domicile, or any other similar criteria would be deemed to be resident of India only if such person has a total income more than 15 lakhs from the Indian source. I'm not talking about foreign source of income. If his Indian source of income is more than 15 lakhs in that previous year, he would be regarded as deemed to be resident. But what are the conditions is that the individual has to be a citizen of India. Second important, he should not be liable to tax in other country, and his Indian income or Indian source income should be more than 15 lakhs. Only in these three conditions that person or resident individual, the individual would be regarded as a deemed to be resident of India. I think this is very important, and they have clarified that what you mean by income from foreign sources would mean income which accrues arising outside India. No, they say that yes, foreign source of income would mean income which accrues or arises outside India, except income derived from a business control in or profession set up in India. And therefore, you will find that this category is incorporated by Finance Act 2021 with effective from assessment at 21-22, that Indian citizen who is not liable to tax any other country and his Indian source of income is more than 15 lakhs, his status automatically become the resident of India. And therefore, in this case, you will find that more and more people who has migrated but who is still a citizen of India have been working abroad. And immediately on the date of when the finance minister announced the budget, and when they clarified on the floor of the parliament about this, a new creature is created under the statute as a stateless person who can become a deemed to be resident. Many of the Indian residents who are migrated in Gulf countries, basically working for their employment purpose, they created basically Allah Gullah. And you will find that immediately, because they were basically lobbied very powerfully with the Ministry of Finance, saying that we are citizen of India. By physical presence, we are not a citizen, resident of India. We are working in Gulf countries. How we can taxable in India because we are citizen of India. So this is the first time under the statute you will find that residential status of the Indian city, the individual would be determined not only the based on the physical stay, but also the based on the citizenship. And therefore, you will find that press release on 2nd February 2021 has been issued by the Ministry of Finance, saying that we don't want to tax any bona fide workers. So if an individual has migrated from India, he is there for the long time, he is working there for the employment purpose or carrying out business activity outside India, we don't want to tax those people in India, because you will find that in Gulf country the tax law is there, but there is a specific exemption to the individual as well as certain the business community who are other than basically oil company or the banking company, all are not paying taxes in those Gulf countries, and therefore they have clearly, and to that extent you will find that how to interpret what the liable to tax. Liable to tax means there are two aspects we need to see: the deemed residency provision to apply only to the Indian citizen and not to a person of Indian origin. I think this is a very important aspect one need to see. The proposed provision governing tax residents to discourage a situation where stateless person arrange their affairs in such a fashion that they are not liable to tax in India as well as the overseas jurisdiction. And liable to tax, you will find that this word has been interpreted means a person who is subject to tax by taxation laws of that state because of nexus between him and the state. So there are two different situations. Liability to taxation is a legal situation, whereas payment of tax is a fiscal fact. I think this is very important, that yes, under the Gulf country law, the individuals are basically liable to tax, but there is a specific exemption has been given, and therefore the controversy was started since we have the landmark judgment under the income. So if anybody wants to understand the Income Tax Act, double tax, the play between double tax avoidance treaty and the Income Tax Act, the Azadi Bachao Andolan is a classical Supreme Court judgment. I think is my humble request to all students, please read this judgment. The judgment touch upon not only upon the taxation aspect, but also upon the Constitution of India. What is the importance of the double tax avoidance treaty? What is the objective of the double tax avoidance treaty? What is the interplay between the Income Tax Act and the domestic tax, double tax avoidance treaty? There the concept, and just wanted to give more 2 minutes on this, the Azadi Bachao Andolan. It was an interesting situation. I think this case basically the period pertaining to financial year 2005 to 2010, you will find that most of the foreign financial institutions started making investment in India, and FII basically are allowed to make investment under the foreign direct investment guideline and in the listed security. And that point of time, there was a specific basically tax law for the long-term capital gain. And under the Income Tax Act, the long-term capital gain was liable to tax at the rate of 10%, 20% at that point of time. So these FI basically are bringing their foreign direct investment They were playing on the Indian stock exchange, buying and purchasing the security and claiming basically, and they were basically liable to tax on the long-term capital gain or short-term capital gain. At that point of time, India entered into three basically, namely the treaties, double tax avoidance treaty with three countries, Singapore, Mauritius and the Cyprus, and you will find that most of the FIR from the developed countries like US, UK, France, they instead of making direct investment from those tax jurisdiction to India, they were basically making investment through Singapore, through Mauritius, and through Cyprus. Why they were making investment? Because India was basically giving a favorable treatment to these three jurisdictions, that if a non-resident who is a resident of Singapore, who is a resident of Mauritius, who is a resident of Cyprus, if he makes investment in India and earn capital gain, those capital gain was not liable to tax in India. So those were the specific exemption given under that treaty. And this, the FI basically, in order to claim this treaty, they were used to do this treaty shopping. Now, treaty shopping is a concept is that if you, instead of making direct investment from the home country to that source country, if you route that investment via some intermediate, the jurisdiction, those cases they will try to basically use the benefit of the treaty of that intermediate jurisdiction and claim the tax exemption. So here in this case also what used to happen, these FI who are basically liable to tax, because under the India-US treaty, under the India-UK treaty, under the India-France treaty, if any non-resident make investment in India, whatever the capital gain you realize, it will be liable to tax in India. But if the investment are routed through Mauritius, Singapore, and the Cyprus, they were not liable to pay taxes. So most of the FI at that point of time, you will find use this basically conduit of this route for making investment in India. Tax department basically started attacking those FI with the argument saying that they are resident of US, UK, from wherever they are incorporated, but they are using this tool, basically routing their investment through these three jurisdictions in order to claim basically the tax advantage of the exemption of the capital gain. And basically, and therefore the tax department say that since, and you will find, and what used to happen when the tax department seen the substance of those entities in those three intermediate jurisdictions, like in Singapore, Mauritius, basically it was a basically paperless company, Khoka company. They were just bringing the fund from US to Mauritius. Immediately, once the Mauritius bank account hit that fund, the inflow of that fund, immediately in the second, they used to transfer that fund from Mauritius to India. And you will find that company was just incorporated in the Mauritius or Singapore, Cyprus only for the purpose of namesake. They don't have substance. They don't have the employees. This thing, they were not maintaining the books of account. Even they have maintained the books account only for the local compliance purpose. In this three jurisdiction, that point of time, there was either no tax or very minimal tax. So ultimately, they use this basically jurisdiction for making investment. And that point of time, Indian tax officer basically denied the tax treaty benefit of India-Mauritius treaty or India-Singapore or India-Cyprus treaty to those the SSE on the ground that in order to avoid the taxes, they have routed this investment. So we disregard this entire arrangement and we will not give any benefit under the treaty. So they denied the treaty of India, Mauritius, India, Cyprus and those capital gain, and they consider, since they are the resident of UK or the USA and they have substance in those countries, and therefore we can tax those capital gain as per India, UK or India, US treaty. And therefore you will find that Azadi Bachao Andolan, the judgment basically, the ex-IRS people, basically income tax officer, has filed a writ petition in the Delhi High Court saying that The Indian domestic people are paying taxes on the long-term capital gain, short-term capital gain, even they play on the stock exchange. Why there is a discrimination? Basically, why the same treatment is not to the non-resident? And I think the point is very valid. And from that perspective, the matter has come to the basically discussion before the Supreme Court was what do you mean by liable to tax? Because this fund or FI were not liable to tax in Mauritius, Cyprus, or the Singapore. And therefore, the word they have interpreted, what do you mean by liable to tax? Liable to tax means I should pay the taxes physically, or the law provides that yes, these entities are resident of India and resident of Mauritius, Singapore, or Maribor, but there is a specific exemption given under those jurisdiction, and therefore those will be regarded still as a resident of India. And one more circular issued at that point of time to encourage more foreign direct investment from the Mauritius, Singapore, this thing, saying that if a non-resident who is incorporated in Mauritius and who can obtain the tax residency certificate of Mauritius, he will be entitled for the treaty benefit. Therefore, the issue came up specifically in the Mauritius, whether the person who is a resident of Mauritius, who is not paying taxes in Mauritius, but still regarded as a resident of Mauritius or not. And from that perspective, I basically request all the students, please read this Azadi Bachao Andolan to understand what you mean by basically liable to tax. And therefore you will find that Finance Act 2021, and because this is the apprehension basically raised by the Indian individuals who migrated outside India working, they are the bona fide workers. What do you mean by liable to tax? And they have brought, so Finance Act 21 made amendment in section 229A to define what you mean by liable to tax. So liable to tax in relation to person means that there is a liability of tax on that person under the law of any country, and will include a case where subsequent to imposition of tax liability an exemption has been provided. So to safeguard the interests of those basically specifically the resident of Dubai, UAE, Saudi Arabia, those countries basically where the law is there, but there is a specific exemption given to the individual. Now, those basically assessees will be protected under the definition of liable tax. So, this is a very important amendment they brought in Finance Act 2021, but has a retrospective effect of 21-22 because the stateless person definition where the word liable tax has been incorporated, and this is very important. So, from that perspective, we will going to see what is the importance of the stateless person. In the next slide, we are going to touch upon certain case study. Now, Section 6(6) of the Income Tax Act provides situation where the person is not an ordinary resident in previous year if the individual or HUF whose manager has been non-resident in India, so 9 out of 10 years or 720 days, 29 days out of these 7 years. I think these are the very important. But two more categories of person who would be regarded as a RNOR is one is a stateless person and second is a person who is a citizen of India, person of Indian origin, and whose income in India more than 15 days and their stay in India is between 120 and 182 days. So if those cases will be regarded as a RNOR. So what is the consequences of RNOR basically? Once a stateless person or the Indian citizen or citizen become a resident of India, you will be liable to tax on your global income, not only in India, but whatever the income you generate outside India. Compliance in the form of filing of return, you require to disclose your assets of outside India. Transfer pricing regulation would be applicable. Black Money Act would be applicable. Withholding tax provision will also applicable because of the certain as per the domestic law and as per the double tax avoidance treaty. Now we are going to touch upon the two situation. I'm going to spend 5 minutes on these 3 slides, and then we can touch upon because the rest of the slides are very large, and therefore situation 1, a contract technician who is not a citizen of India, who is not a person of Indian origin, visited in India for a previous year for the financial year 2021 and stays in India for a period of 190 days in that financial year. He has visited and stayed in India for 450 days, 455 days in previous 4 years. What will be his residential status? He is not a citizen of India. He is not a person of Indian origin. That means he is a foreigner, basically working in India in the previous more than 190 days. So we have the two conditions we have seen: 182 days or 60 days or more, or 365 and 365 days out of 4 years. So if you see, I am fulfilling both the conditions, more than 182 days and the 365 out of 4 years, and during the previous I am 190 days in India. So this person will become a situation, one person become a resident of India. So 455 days of the irrelevant this thing. Second situation, what will be his residential status if he stay in India for a period of 65 days in 2021 and Indian source of income is more than 15,50,000 in financial 2021. He stay in India in the previous 4 years, 455 days. Now we need to understand that he is not a citizen of India. He is not a person of Indian origin. So therefore the criteria of 15 lakhs is immaterial. Indian source of income, 15 lakhs above criteria is applicable if he is a citizen of India or a person of Indian origin. So foreign resident, foreigner, this criteria is not applicable. The first test of resident is that he should be in India more than 180 days. Now in this case, he is less than 65 days and therefore this criteria is not fulfilling, or he should be in India more than 60 days and he should be in India more than 365 days out of 4 years. Now let's see. Here he is fulfilling the condition first 182 days. That test is not applicable. In second test, he is fulfilling the first condition of more than 60 days in the previous year and fulfilling the second condition 365 out of the 4 years. And therefore in the second situation also he will become a resident of India because he is fulfilling the test 2. Now, citizen of India, 15 lakhs, these are income criteria is not important in the case of the foreign citizen person. Now, let's take a second case study, specifically in the case of the citizen of India and Indian resident. You will find that Indian IT engineer who is a citizen of India, who is migrated in USA for the employment purpose, comes on a visit to India. Number of visit days in financial 2021 is 155 days in the first situation. He's been staying more than 365 days out of 4 years. His income in Indian source is more than 15 lakhs. Now in this case, what will be his status, whether resident or non-resident? So let's go by the test 1. Test 1, his number of visits in India is 155 days. That means less than 182 days. So first test, non-resident. Now second test we need to see. That second test you will find that 60 days or 365 days out of 4 years. Now as far as the 60 days is concerned, as we have seen that for the Indian citizen person or the person of Indian origin, that 60 days criteria has been extended, was extended to 182 days. But Finance Act 2020, Finance Act 20, with effect from 21-22, we need to see the 120 days criteria also. So in the previous year, he has been there for more than 120 days and his income is also more than 15 lakh during the previous year, and therefore his residential status for the year will become a resident and he will be regarded as a resident but not a resident. Okay. Second situation we will see that 155 days previous year, 365, more than 365 out of 4 years, but the third condition is 15 lakhs. Now in this case, what will happen? Yes, 60 days criteria, his 120 days criteria is fulfilling, but his income in India is less than 15 lakhs. and therefore he is not fulfilling the condition of section 1A, the subsection 1 explanation, and also 1A, and therefore he will become a non-resident for the second situation. Now third situation, 155 days, but he is not fulfilling the condition of 360 out of 4 years. Whether the Indian source of income exceeds 15 lakhs, not relevant, because in this case, what is happening, that second test, in that two cumulative conditions are there. One is the more than 60 days or 120 days here in this case, and the second is a 365. So I'm not fulfilling the condition of 365, more than 365 out of 4 years, and therefore I will still become a non-resident. Now, fourth situation, which we need to see, 185 days. I'm not there for the more than 365 days. I'm not there for more than 50, but he stayed more than 185 days. Now, forget about the second test. In the first test itself, he becomes spending more than 182 days, and therefore he will automatically become a resident of India and resident but not resident. So only if individual has been 9 out of 10 years, then that we need to see as far as the RNOR concern is concerned. So I think we need to keep in mind about this important distinction. Now let's go to the second case study. I think this is also very important, that consider an Indian citizen having stayed in India for more than 50 days and he is not liable to tax any other country. This is regarding the stateless person. Reason of his domicile or residence or any criteria of similar nature and his Indian source of income. In the first situation, he is earning income more than 16 lakhs. In second situation, he is earning more than 14 lakh. So this stateless person, this subsection 1A to section 6, this is a new criteria. That's why I said that for first criteria, Indian citizen and person of origin, and the second criteria is stateless person, deemed residency rule is applicable only to the Indian citizen. But what is important is that 16 lakhs and 14 lakhs, more than 15 lakhs or less than 15 lakhs. So in the first situation, his income is more than 60 lakhs, but he stayed in India for 50 days. In those cases, what will happen? Now you will find that 50 days criteria is not there for this stateless person, and therefore he will be deemed resident on the basis that he is an Indian citizen, not liable to tax in any other country. Of course, now we need to also understand liable to tax. Especially in the case of Gulf countries, if a person is having more than 15 lakhs income in India, still that person will not be regarded as the deemed residency. He will not qualify that. But if the income is less than 14 lakhs, then in that case, what will be the residential status? In that case, the deemed residential status will not be applicable because his Indian source of income is less than 15 lakhs. So we need to understand, if his income is less than 15 lakhs, then the stateless residency deeming fiction will not be applicable. If his income is only above 15 lakhs, then only we need to see, yes, he may fall under deemed residency, but whether he is not liable to tax in other jurisdiction, for that purpose, we need to see the law of that jurisdiction. Now, this liable to tax definition has brought a new, basically, dispute. Is going to have a dispute, not in relation to the bona fide workers who are working in Dubai, but certain countries where, specific person like partnership firm is not regarded as a person in UK. So partnership firm is not liable to tax in UK, but the partners of the partnership firm liable to tax in respect of their share of profit. And therefore, we need to understand from that perspective, the liable tax which they define under section 2122 is basically the firm assessment 2122 should not basically give the benefit of those treaty. So we need to understand what is the importance of the liable tax. In union cases, those should not come in the problematic situation, but in the basically like resident individual working in Gulf countries they will get benefit of this definition of liable to tax, which is specifically imported under the Income Tax Act. But under the treaty, like India UAE treaty, if you see the Article 4 of the Double Tax Avoidance Treaty, they define what you mean by resident. So they use the word residency, the domicile, or the effective, vital economic interest. Those basically conditions will determine the residential status. What will happen in those cases? Because they use the liable to tax. Now that word is not there under the India UAE treaty. India UAE treaty is different than the other treaty, where India UAE treaty talks about not liable to tax, but they talk about physical stay. If that person staying more than 182 days, then he automatically become a resident of UAE. But if you compare that definition of resident under Article 4 of India UAE treaty with other treaty, you will find there is a quite difference between the treaties. So from that perspective, this is very important. After considering the residential status, let's go by the presumptive taxation. And here you will find there are four important sections under the Income Tax Act, which deals about presumptive taxation. Basically, presumptive taxation means those foreigners will be liable to tax in India on presumptive tax basis. Now, presumptive tax basis, if you see section 44B, 44BA, all these sections, you will find that income will not be liable to tax, entire income will not be liable to tax. 7.5% or 5% or 10% of the specified sum earned by that foreign company carrying on business of shipping business or aircraft business or turnkey project or the extraction of production mineral oil, those cases you will find those company will be, the taxable income would be 7.5% or 5% or 10% of that gross receipts. So suppose a foreign company having a shipping business in India, they are incorporated outside India, place of effective management of that foreign company is also outside India. So we need to understand what is the tax implication of that shipping foreign company in India. So under section 44B, suppose he is having a gross receipt by way of carriage of goods, carriage of passengers, livestock. Those cases, if he earn, suppose 1 lakh income from India, 1 lakh income, I'm talking about gross receipts. So 7.5% of 1 lakh, basically that income, like 7.5% is from 10 lakh, 10% comes to 10,000. So 7,500 rupees will also consider as a taxable income of a shipping foreign company in India, and that 7,500 will be liable to tax at the rate of 40%. So this is how the presumptive tax work out. Now, there is an option given under the Income Tax Act specifically only for the extraction or production of mineral oil. Those companies who are providing services facility to this type of activity, or the turnkey project in the power contracts, those cases they have given option. Either you file return or declare your income under section 44BB or 44BBB, or you maintain a books of account. For those SSC who are covered by 44B, 44BBA, books of account is not required to be maintained. Whatever the gross receipts you earn, the Income Tax Act will deem certain income based on 7.5% or 5% of gross receipt, and you required to pay 40% tax on that. But under section 44BB and 44BBB, if you feel that my taxable income after claiming certain expenditure incurred for carrying out this activity in India is less than the 10% or 10% deemed profit, in those cases, they are allowed to maintain books of account, get done their accounts audited under section 44AB. If that profit is less than this deemed profit, then those SSC are allowed to declare the profit based on that basis. So therefore, we need to understand that what is the taxability. So these are the four categories of the SSC: shipping business, operation of aircraft, turnkey project, oil and exploration, the production of and extraction of mineral oil, those assets are getting covered by the presumptive tax. After considering we require to go to the extension to section 5(2). Now section 9, you are aware that certain income are deemed to accrue or arise in India, and this basically concept has been basically interpreted in section 9. Section 911 deals with the business connection concept. Under the treaty, you will find this business connection concept is replaced by the permanent establishment. Property, if the assets or property located in India, if the source of income or the capital gain in relation to transfer of assets is situated in India, so that tax liability will be covered by section 911. Suppose a non-resident having a salary income in India, outside India, section 912, non-resident having income from dividend, interest, royalty and fees for technical services, those respective. Now, by having section 9 into the Income Tax Act, India follows the source-based taxation. India is a developing country, and therefore source-based taxation is being inbuilt in section 9 of the Income Tax Act. So since India is a developing country, India want to protect its tax base by basically levying a tax on the non-resident salary or non-resident dividend, non-resident interest income, royalty, FTS, those type of or capital gain or business connection, those type of income will be liable to tax in India. I will touch upon 2-3 basically points in the each slide so that you will get a flavor that what type of income are deemed to accrue or arise in India. So classical case I would like to consider in the case of this Karimba Ibrahim, where the tangible property of a non-resident was situated in India and there was an income earned. So for example, if Pfizer Private Limited, Pfizer India, shareholders are a non-resident, and if those non-resident wants to sell their shares of that Pfizer India to another non-resident or Indian resident, what will be the tax liability? Now, since the assets, basically, what are the assets in India? Shares of that Indian company is regarded as assets in India because the register of shareholders of that Indian company is located in India, and therefore the shares of the Indian company would be regarded as assets located in India, or either irrespective of fact, it will be held by a non-resident, and therefore those assets, those shares, if I transfer by, those shares are transferred by non-resident to non-resident or resident, that tax liability, any capital gain arising from that transaction are deemed to accrue or arise in India as per section 9(1). Second classical case, you must have heard about Vodafone. I think Vodafone has created history and under the Indian law, and you will find that there is the power under the Constitution of India. The Parliament has a sovereign power to create a law, make a law, and make a retrospective amendment in the Act. And Vodafone judgment has created havoc in the globally, and therefore you will find that most non-resident has the apprehension about foreign direct investment whenever they are making in India, and this Vodafone has created that problem by making a retrospective amendment. The foreigner found that yes, Indian economy has opened up, but their Indian domestic tax law is that adamant that they are making a retrospective amendment, and which has jeopardized a lot of foreign direct investment. So therefore, you will find this judgment is very important to understand. Now, in the case of Vodafone, the facts were there. Vodafone India was basically held by the tax haven country was basically holding the shares in India through intermediary subsidies company. What happened outside India is that the Orange, which we have, earlier this company Orange, basically that company basically Hutchison was holding the shares in India, and Hutchison sold the shares to Vodafone. The issue came up that whether, and then what happened? that Indian companies' shares was not transferred. Indian companies were share held by the intermediary companies, and the ultimate intermediary company, the grandfather company's shares got transferred from Hutchison to Vodafone. As you are aware, Section 195 of the Income Tax Act, where resident person, whenever he is making a payment to a non-resident, he is required to or obliged to withhold tax under Section 195 of the Income Tax Act. That point of time, Vodafone did not deduct tax at source while buying the shares of a Hutchison company outside India on the basically premises that I'm not transferring the shares of the Indian company. What they had transferred the shares of the foreign company, but that foreign company was ultimately holding the shares in the Indian company through layer of the intermediary company. The income tax department attacked the Vodafone basically on that basis, saying that Vodafone was supposed to deduct tax at source because whatever the capital gain they realize on sale of that foreign company is deemed to accrue or arise in India. Why they used the deemed to accrue or arise in India? They were saying that this Vodafone, which was the ultimate company who had sold the shares, was not having any business, was not having an asset except the investment in the shares of the Indian company. So all those intermediary companies also was not having any substantial asset. And the value of that shares of a foreign company basically ultimately substantial part was basically generated out of the value of the Indian business, which was basically housed in the Indian Vodafone company. And therefore, the tax department argued was that there was an indirect transfer of assets because economic interest of that foreign company was basically in India. And therefore, they interpreted the word that for the purpose of Section 9(1), not only the direct transfer of the Indian entity, but even indirect transfer of assets will be subject to tax because substantial value of that foreign company was coming out of the Vodafone Indian business. And therefore, the matter went up to the finally up to the Vodafone Supreme Court this thing, and Supreme Court has ruled out that Vodafone doesn't have the direct business in India. They are holding the shares through intermediary company, and therefore nothing will be liable to tax. It can at the most consider indirect transfer of asset and not a direct transfer of asset. And that point of time, Section 911 talking about only the direct transfer of asset. And from the financial year 2011-12, when the Supreme Court Vodafone passed the judgment allowing the benefit of capital gain taxation to the Hutchison and also as the Vodafone, the Parliament made a retrospective amendment in the Act with retrospective from assessment in 2001-2002, saying that any indirect transfer of asset outside India having substantial value from asset located in India will also liable to tax in India. So Section 911 is very important to understand, but at the same time, one can also look at it, the double tax avoidance treaty, what are the capital gain article, what is the tax implication under the treaty. If that treaty article, because under Section 90 of the Income Tax Act or the double tax avoidance treaty, if the treatment is beneficial either of in each this thing to Income Tax Act or the treaty, then that will be applicable to the non-resident. So from that perspective, so this is a Vodafone judgment. So two judgment I would request to all students to read. One is Azadi Bachao Andolan and second is this Vodafone judgment. And second important thing is that Vodafone ultimately you must have heard about recently. Vodafone has succeeded even their appeal under the investment treaty. So we have the two types of treaty. One is the double tax avoidance tax treaty and second is the investment treaty. And under the investment treaty, we gave the assurance to the foreign investor that whenever they are making investment in India, whatever the law thereafter, if they want to change the law under the in India, they cannot have a retrospective effect which may jeopardize their investment in India. And under the investment treaty also, they have basically succeeded, and Vodafone got a substantial relief for this capital gain also, because by making a retrospective amendment the Income Tax Act, again Income Tax department basically attacked the Vodafone, saying that this capital gain will have retrospective amendment, and therefore the capital gain earned by the Hutchison, Vodafone should have deducted under 195 TDS. They are not dead, so they have basically attacked the Vodafone for collecting the tax. I think this is very important. Second important aspect I just wanted to highlight here, the capital gain tax will be attracted when non-resident Indian sells any capital asset situated in India. And this is a classical case you must have seen, that non-resident individual basically having still some house property in India, and you will come across that, or your relative who is a non-resident wants to sell off that house property in India. So therefore, we need to understand whether any capital gain arising to that in the hands of NRI will be liable to tax in India or not. As per section 911, since the house is located in India, situated in India, any capital gain arising to the non-resident will be liable to tax. And because the tax is liable, the issue come up, section 195 will trigger or not. Section 195 would trigger because the person who is buying this house from a non-resident Indian is required to deduct tax at source under section 195, withholding tax. And therefore, these two judgment also, Meena Patil and this thing also very important, that now the second important interesting issue come up that non-resident may advise the resident or the buyer that please don't remit this fund to my account outside India. Please remit this fund to my local account in India. And therefore the issue come up whether section 195 would trigger or not. As you as section 195 of the Income Tax Act, whenever resident makes a payment out to the non-resident, it is subject to tax. The issue comes up only that payment is made to non-resident but is not repatriated outside India, and therefore section 195 would trigger or not. The question is that yes, the answer is that section 195 would trigger, irrespective of fact whether non-resident I'm making a remittance outside India or whether I'm making a remittance to his Indian bank account. As far as I'm buying the assets from the NRI or non-resident, I'm supposed to deduct tax at source under section 195. I think this is very important because for the domestic buyer and seller of the house property, 1% TDS, but the resident buying a property from non-resident, 20% is a TDS. So we need, because long-term capital gain tax is taxable at the rate of 20%. Of course, he will be entitled for the indexation benefit, but you require to go through the compliance process under section 195. Then in that case, form 15CB, form 10F, those things, or lower withholding tax, those issues may require to consider. Now, if the foreign company is liable to tax in India, whether entire income will be liable to tax? No. Under section 911, whatever the income attributable to the activities of the foreigner in India, only those income will be liable to tax. So therefore, this is also very important that no operation of business carried out in the taxable territory, the income accrued abroad through or from any business cannot be deemed to accrue as in India. So whatever the income attributable to the Indian activity, only that income will be liable to tax. So suppose I have a turnkey project. Suppose a foreign company, ONGC has given a turnkey project to the foreign company. And there are two aspects of that turnkey project. One is the offshore supply and onshore supply. Second aspect is the offshore services and onshore services. So foreign company will depute certain employees in India for carrying out the services. Certain services will be carried out outside India. In those cases, you need to determine what is the income is attributable in the hands of foreign company in India. Offshore supply of machinery, free on board basis, if foreigner has supplied to the Indian company, it will not be taxable in India. But if the supply of machinery delivery happen in India on the CF basis, here there is a possibility that it may taxable, but one may argue that what portion of that is taxable. Whatever, as I mentioned, whatever the activity, whatever the income attributable to that activity will only get taxable. So these are the important judgment as far as the offshore supply of machinery and equipment. So one needs to be very careful. We are going to touch upon services also. So this slide we touch upon the offshore supply. Second important aspect, I think one needs to see that if the foreigner earning a salary in India, whether it will be lab root tax, not lab root tax. So section 912 deals that salary earned in India means salary payable for services rendered in India. And the rest period of the leave period, which is preceded or succeeded by such services rendered in India, will form part of the contract of employment. So these two types of basically salary will be lab root tax. So what is important is that non-resident, physical stay of that non-resident, and where the services has been provided by that person. So take one example. If a non-resident is basically employee of a foreign company, he is an employee of a foreign company but deputed in India for carrying out the services in India. In those cases, first of all, we need to identify what is his residential status, resident or not resident. If it's a resident, his salary, global salary will be lab root tax. But if it's a non-resident, in those cases, whatever the salary he earned while rendering services in India, only those salary will be lab root tax. So it is possible that 9 months he earned salary outside India and 3 months salary he received in India. So only 3 months salary will be lab root tax, because what is the important condition for getting salary tax in India? Where the services has been rendered. Take the other example, that in the Infosys India deputed the software engineer from India to USA. Indian employer, Indian employee. He is providing services outside India because he migrated, he deputed outside India. So where the citation of the service? Now here, although he is an employee of the Indian employer, but since he is rendering services outside India, and if he is a non-resident, nothing will be lab root tax in India. So it is possible in the previous year, his stay in India is more than 182 days. Then in that case, he will become resident, his global income will be lab root tax. But suppose he is arranged in such a way that his stay in India is less than 182 days, and he earns salary, so only those salary which he earn in India, so outside India for the services rendered outside India, only those salary will get exemption under section 912. So the where the services render is very important, and these are the certain case law. You will find that sometime you are the resident, like the Indian resident basically, who has been migrated or deputed outside India. Sometimes he requests the employer that please either you remit my salary entirely outside India, or you please credit my salary income to my Indian bank account, either in NRE account, non-resident external account, where you can keep the money in convertible foreign exchange and repatriate outside India anytime, or normal saving account. Now in those cases, what will the tax liability? The tax liability difference will be there, because if he is receiving salary outside India, although it may be by the Indian resident, Indian employer, but since the services has been rendered outside India, he is a non-resident, nothing will be taxable. But such non-resident opted for getting salary in the Indian bank account, then section 912 will not trigger, section 52 will trigger, because under section 52, where the scope of total income of non-resident is that if he received something in India, it will be taxable irrespective of his status as a non-resident. And now, specifically in the section 912, the rendition of services also irrelevant. But there are certain case laws are there under the income tax tribunal and the High Court, where the judgment has been given on both sides. Wherever they have received salary in India, some of the court interpreted this, yes, it is taxable on receipt basis. Some of the court has held that no, since the services has been rendered outside India, he is a non-resident, irrespective of the fact that his salary received in India, it is not taxable. But frankly speaking, theoretically, if you ask me, whenever you are received, non-resident received any salary in India, it will always get taxable in India as per section 5. You don't have to go to the deeming provision. You must have seen that section 5.2, which we discussed earlier, that two components are there. I just go back to that the earlier slide, where you will understand why I'm harking upon the section 5.2. Section 5.2 is talking about income received or deemed to be received in India. In the first category, income received itself, under section 5.2, the salary get taxable. I don't have to go to the deeming fiction at all. And therefore, one may argue that since the salary has been received in India on receipt basis, it will be taxable. Similarly, this also apply to a foreigner who doesn't have income from salary but has some other business income. But if they received something in India in their bank account or investing in India, it will be liable to tax on the receipt basis. Dividend income paid by non-resident by Indian companies deemed to accrue as India only on payment, not on declaration. Section 914 deals with, as you aware, from assessment at 21-22, we have changed the law of the taxation of dividend. We used to pay dividend distribution tax. Indian company used to pay dividend distribution tax. It was tax-free in the hands of the shareholder. From 21-22, law has changed. Now, dividend will be liable to tax in the hands of the shareholder. No DDT is applicable. And therefore, this section 914 perspective, whenever the Indian company declares the dividend to the non-resident, it will be always taxable in India. And the Indian company is required to deduct tax at source under section 195 of the Income Tax Act. Fees for technical services and royalty. The law made amendment in 1976. They brought this source rule where interest, royalty, fees for technical services, liable to tax. And this is interesting, basically, extraterritorial. This judgment, the law is very extraterritorial in operation, and therefore one needs to be very, very careful understanding the FTS, interest, and the royalty taxation. Fees for technical services. Here also I would request all members to please read the Supreme Court judgment in the case of Ishikawa Jima Harima judgment, Clifford Chand judgment, Ashapura judgment, which basically, because this law is evolving, and as I mentioned to you that India is a developing country, and therefore India believes on the source-based taxation. And this is the first time happened in India where the law has amended in section 917, which interpreted that as per the Ishikawa Jima Harima judgment, in order to establish the territorial nexus, the service has to be rendered in India and utilize India. That foreigner basically has to have some nexus, connection to India in order to Indian tax to be attracted. And therefore, this Supreme Court judgment has brought the concept of territorial nexus. And our Constitution of India, basically the origin goes to the Constitution of India, that the Indian tax law cannot be extraterritorial in nature, but the source rule is an exception to that, and therefore the first time the Supreme Court, after this passing Supreme Court, the Income Tax Act made amendment under the Income Tax Act, where the Ishikawa judgment and the Clifford Chand judgment, the foreigner had basically provided the technical service to the Indian company. And therefore the issue came up. The services has been rendered outside India, but the recipient of the services were the Indian residents. And therefore the issue came up whether FTS, fees for technical services, is liable to tax in India. And in order to establish the territorial nexus, the Supreme Court held that in order to tax the services in India, the services has to be rendered in India and has to be utilized in India. If you fulfill this both condition, twin condition, then only that fees for technical services is liable to tax in India, deemed to accrue or arise in India. But for example, if the foreign company has never come down India, all service has been rendered outside India, but the recipient of services is Indian company is making a payment for that services. Are you going to tax those type of income? To that extent, so they brought therefore the Supreme Court came to the rescue of the SSE, saying that yes, the income will not be taxable because there is no territorial nexus has been proved, because service has been rendered outside India. and but utilized in India, so has not fulfilled either of the condition and therefore not taxable. But the law has made amendment, explanation to section 9156 and 7, they brought it that irrespective of fact whether that person has a presence in India or whether that person has a utilized in India, as far as Indian resident is making a payment to that non-resident, it is deemed to accrue arise in India. I think this is very important aspects one need to see, and this GVK industry is also very important judgment. Article 245 of the Constitution, which talks about Parliament powers to enact legislation pursuant to Section 245, and which may have extend to extraterritorial aspect. The other important aspect I need to see that every student should read this Palkiwala commentary. The Palkiwala commentary is a Bible for all the tax students, basically. Not only the student, but also as profession also. Whenever you get opportunity, please buy a latest copy. Edition has been basically issued. This is the 11th edition of the commentary. I humble request to everyone, including professional people also, if you want to practice the tax law, one should read the Palkiwala commentary. And Palkiwala has given a wonderful comment on the extraterritorial nature. Whether this is a valid law, not valid law, I think one needs to understand. He has given a very small example where we can understand. The example was that Indian resident basically, and I'm just comparing that normal, now Indian residents are going abroad for the visit, vacation, traveling, and sometimes they end up buying certain goods from outside India. Suppose I happen to go to the USA, and in the shopping mall in USA, if I'm buying some goods, okay, whether whatever the amount I paid to that non-resident, whether liable to tax in India. Because under section 195 of the Income Tax Act, whenever Indian residents are making a payment to non-resident, the Indian resident is supposed to deduct or withhold tax on that, the payment. But I have gone outside India, I have basically purchased certain goods and services outside India. That person, non-resident, is also located in outside India. He never come down in India. Can the income tax law can implicate the non-resident for the purpose of some 195 or so that is called the territorial nexus. So how the law is an extraterritorial aspect, just wanted to explain you that how 195, because the foreigner will say, you have come to in USA, you are buying goods from me. I have not visited India. I have not sold anything while rendering or while visiting in India. Why the Income Tax Act in India is applicable to me? So this is very important concept. If one needs to understand, please read the Palkiwala commentary, which emphasize on the how the Indian law is extraterritorial aspect, whether it is a good sign under the double tax awarded status. So one needs to be very careful in understanding these all aspects. Fees for technical services, one need to see that if any person resident makes the payment to non-resident for utilizing services for their profession in India or for the purpose of earning any income from outside India, those basically are exempted. So that's why if you see section 917, this is very important that whenever Indian resident person making a FTS payment to outside India, everything is taxable. The exception is there that if any fees payable for carrying out business outside India by a resident person, or if I'm utilizing these services for earning any foreign exchange outside India, in those cases, those FTS will not. So the best example is the commission, foreign agent commission. Basically, in this case, what happened? Indian resident has appointed some foreign agent for securing the export order. Based on his order, based on his input, I get some export order. So for that purpose, he earns certain commission on that export payment. So whenever Indian resident making an export commission payment to that foreign agent, whether that will be regarded as a fees for technical services, because fees for technical services will be for managerial, technical or consultancy services. One may argue that it may in the nature of consultancy services. But the other important point is that all type of services will be liable to tax? No. Exception to 917, if I have availed these services for earning a foreign exchange outside India, or if I avail services for some project outside India, those payments which are made for those consultancy or managerial technical services will not be liable to tax. So this is a very important aspect, that you don't have to go to the treaty, but under the domestic tax law also there are the exception situations. So what do you mean by, if the services basically utilized for the Indian business, or if I am earning certain income out of that in India, in those cases only the FTS would be taxable under section 917. These are the certain judgments are there to understand, what you mean by technical services, whether standard facility payable to the mobile operator who is a non-resident, whether liable to tax, expenditure incurred for making earning from foreign source of income. These are the very important judgment one needs to see. These are the export commission, certain judicial, and I believe that this my presentation slides will be circulated to all students. Royalty will be also liable to tax under section 916. Consideration for the royalty, transfer of all or any rights. If I transfer patent, invention, design, secret formula, copyright, the consideration for sale and distribution or exhibition of cinematography film, which is also brought under the royalty definition from 21-22 assessment year. So this is a very important aspect one need to see. Earlier, this consideration was not covered under royalty and therefore it got exempt under section 916. Now, specifically from 21-22, if the non-resident sell or distribute any film to the Indian resident, those would be also regarded as a royalty in the hands of a non-resident. Technical commercial knowledge or use of trademark, design, secret formula, equipment, use of equipment. So rental payment I am making for the use of equipment, that will also be regarded as a royalty. These are the certain judgment and important judgment I would like to highlight, that if I subscribing the software database, whether software will be liable to tax, not liable to tax. Software basically is nothing but a secret formula. And if the non-resident is basically giving you the license for the subscribing that database, as per section 916 of the Income Tax Act, it will get taxable. But under the treaty, one may look at the definition of the royalty, because under the treaty, the royalty definition is very narrow. Not all types of payment are covered under the royalty under the treaty. Only certain, use of technology know-how, design, outright purchase, copyrighted article. Now there is always dispute between the payment for the use of copyrighted article and payment for the use of the copyright. If I'm making a payment for the use of copyright to the non-resident, yes, it will get covered under the definition of royalty. But if I'm making a payment for the use of copyrighted articles, like the off-the-shelf software or customized software, in those cases, one may argue that I'm not paying for buying the copyright, but I'm paying for the use of copyrighted article. Use of copyrighted article is not covered under section. So one may argue on that point and try to distinguish. Sometimes I purchase the hardware, software I purchase along with the hardware. So software is inextricably linked to the software. So in those cases, basically, you will find that certain treaties under the Income Tax Act, even the software is attached to the hardware, it is taxable. But under the treaty, certain exemption has been given, that if the technical services or the software is attached or inextricably linked to the purchase of hardware or the computer or any main item, those cases would not be regarded as a royalty or fees for service. It is like a purchase of goods only. Interest also, if I borrowed a fund from a non-resident and if I'm paying interest, those interests will be liable to tax in the hands of the foreigner. Now let's go to the double tax avoidance treaty, because double tax avoidance treaty, you will find that under section 90 of the Income Tax Act, non-resident has an option either to be governed by the domestic tax law, Indian Income Tax Act, or the double tax avoidance treaty, whichever is beneficial to him. And DT is normally negotiated by the two sovereign countries. It is a bilateral. There are two types of agreement: unilateral agreement and bilateral agreement. DTA basically two sovereign countries negotiate the treaty, negotiate the terms of the treaty based on the principle of international law. And we have the concept of that, you know, there's an international law, Vienna Convention on the law of treaty. It is an international law codified, and most of the countries has used the Vienna Convention law in drafting the treaty between the two countries. So our most of the double tax avoidance or bilateral treaties are based on the Vienna Convention, and the Vienna Convention basically provides the two this thing. One is that what is the interpretation of certain word, what are the basically, because normally whenever two countries enter, they use the interpret the treaties in the good faith. Those treaties, subsequent amendment in those treaties should not have retrospective amendment which jeopardize the interest. So in Vodafone case also you will find that under the investment treaty India, which India has with Netherlands, Vodafone invoked the Netherlands-India investment treaty, where they have argued with the Indian tax, the authority, the competent authority, the court authority, saying that India has retrospectively made the amendment and it has jeopardized their investment in India. And basically under the treaty also, because of our retrospective amendment in section 911, they brought basically the concept of that each treaty should not have a, whatever the amendment you make it prospective going forward, not a retrospective amendment, which India has done. And that's why it's created panic amongst the foreigner. DTS lays down the allocation of rule for taxation income. As I mentioned, source country, residence country, bilateral relief is there, exemption method, tax credit method. Unilateral relief is also available under the section 90, basically talks about the bilateral relief, and section 91, wherever India doesn't have a treaty, under the domestic tax law, we have the unilateral relief to that non-resident. India entered into DTA with more than 100 countries. Yes, so far so good. India has entered into 100 countries. So like a resident, he is earning any income from the foreign source of income. And suppose India doesn't have treaty with that foreign country, whatever the tax deducted in that foreign company, whether Indian resident will be able to claim, because Indian resident will be liable to tax on the global income. The foreign source of income will also be taxable in India, but whatever the tax you paid in the foreign country under section 91, since India doesn't have treaty with that foreign company, India give the benefit of that taxes which has been suffered in the foreign country while computed tax. So suppose I'm paying tax in India at the rate of 30%, and on that foreign source of income 10% TDS is already deducted in foreign source of income. So in India, while making a payment, I don't have to pay tax on 10% because 10% already paid. So 30% minus 10%, so only on 20% the Indian resident is required to pay tax in India. So you will get automatically credited for the foreign tax. Different types of models are there for DTA. There are three most prominent and often used models: UN model, OECD model, and the US model. OECD model, as I mentioned to you, that this is the Organization of Economic Cooperation and Development model, where the most of the developed countries are their members, and they advocate the principle of residence-based taxation. Under the UN model, basically most of the members are the developing countries are the members, and it trusts upon the model of source principle. So India follows the UN model in most of the treaty, and therefore you will find that we have the tedious provision under the treaty also, that 10% and those taxes will be subject to deduct, but in the home resident country they will be taxable on the global income. Section 90(2), the non-resident has given the option either by Income Tax Act or the treaty which is beneficial to them. In order to claim treaty benefit under section 90(4), tax residency certificate is a must. If you don't obtain the tax residency certificate, you are not entitled to claim any treaty benefit. And therefore you will find that 195 certification, whenever chartered accountant firm or article clerk or the student is doing, at that point of time we normally ask that taxation certificate of non-resident. If he doesn't have taxation certificate, we are asking the PAN number whether that is having or not. If PAN is not having, then section 206AA is applicable or not. So those are the basically the procedure we require to follow. So tax residence certificate is very important in order to avail the treaty benefit. That means you require to produce a certificate from the foreign tax officer saying that so and so foreign company is liable to tax, paying tax return in that country, and therefore they are tax resident of that foreign entity. So you require that certificate. Similarly, foreign tax jurisdiction also where Indian resident is earning certain income, and if Indian resident wants to claim certain treaty benefit, in those cases also Indian resident has to obtain the tax residence certificate from the Indian tax authority under whose jurisdiction you are liable to paying taxes, or your income tax is assessed under his jurisdiction. He will issue the TRC, and that TRC you require to submit in the foreign tax jurisdiction. Otherwise, you will not be eligible for the treaty benefit. Now, the new concept has brought under the statute is multilateral instrument. That sometime, so far so good, developing country were crying while paying tax, making the payment to the developed country that we want our pie of tax in that source country. But now there's a tussle between developed country and developed country also, and therefore you will find that now developed countries have started fighting, and that's why you will find that the new concept of base erosion profit shifting concept has brought on the statute. On the basically at the OECD. So G20 country has basically requested OECD that in order to, because sometimes DTS, double tax avoidance, also creating certain opportunities for the non-taxation or reduced taxation to the new to treaty partners. So now under the multilateral instrument, even under the DTA, if anybody is taking advantage of the treaty, the multilateral instrument has plugged the loophole of the treaty also. And under section 90, you will find that multilateral instrument, this concept has brought under section 90, that DTA should not create opportunity for the non-taxation or reduced taxation, including through treaty shopping in order to align the purpose of DTA with the multilateral instrument. So we are going to touch upon that aspect also. Before that, the CBDT circular number 333 dated 2nd April 1982 is also very important, because that circular issued by the CBDT has given that non-resident has an option either to be governed by treaty or by the Income Tax Act, which is beneficial to them. And treaty is basically the bilateral instrument. Two sovereign countries sit together, competent authorities sitting together and negotiate deals, and thereafter they enter into treaty. So which has a bilateral binding in nature. Now these are the certain articles under treaty. You will find that article 1 to 30, which basically deals about the taxation of the non-resident. The important article is what are the taxes covered. Article 3 basically provide the definitions. Article 4 is very important, the residence. So under the income tax, so whenever the non-resident taxability is concerned, we require to understand the resident of non-resident. We require to examine the residence definition under the Income Tax Act as well as under the treaty. Either of the treaty or the income tax, whichever is beneficial to him, he will be allowed to use that definition. So it is very important. Next concept is a permanent establishment. Foreigners are liable to tax if as a business income if they have permanent establishment in India. And if they don't have permanent establishment in India, normal buy and sale of goods, which is a business income, is not liable to tax. But if the payment is made for the fees for technical services, royalty, then there is a separate article, article 10, 11, 12, which basically deals about fees for technical services and the royalty. Article 13 deals about capital gain taxation. So wherever the non-resident earn capital gain in India, we require to examine the treaty provision, we require to examine the domestic tax flow provision. Whatever the beneficial to that non-resident, we require to basically govern by that. Independent personal services, dependent personal services, independent personal services where only professional category of people are basically covered. So I am taking a payment to architect, doctor, lawyer, chartered accountant. Those services basically covered under the independent services. Dependent personal services, short stay exemption. Like employment, salary. Now, salary under section 912 I need to examine, and under article 15, dependent person services. If the salary earned by non-resident, and if you have dependent person service under article 15, we require to examine the tax implication of salary under the article 15. Whichever is beneficial to him, he will be entitled for that benefit. There are the other rest of the item are there. I'm not going. Of course, article 23 is very important. How the TDS foreign tax credit will be claimed. Article 23 is very important. Article 25 is very important. Mutual agreement procedure. Wherever any taxation happen because of the interpretation issue or because of transfer pricing issue, you will find a mutual agreement procedure entered by the two competent authorities and negotiate the specific case of that non-resident. Exchange of information, you will find that very many non-residents or very many residents basically earning certain income outside India never disclose their outside income. So now the exchange of information treaties are also entered by the two sovereign countries, where like a Nirav Modi case or like Vijay Mallya cases, where you'll find that the foreign tax authority will share their income tax or their income or property into the India. So they have entered into those treaty. So where India can basically implicate those the SSE who are running away from India and basically not paying taxes. So they can request the counterpart of that other country and they can collect those taxes on behalf of India. So this is very important. Vienna Convention, we have just see these are the certain principles on the basis of which treaty has been objective of tax treaty. I think this is very important. And if you see wherever you are reading Article 1 of any treaty which talks about the objective of tax treaty, or even under Section 90 also, but sometimes the objective of tax treaty is not only to enter into treaty for double avoidance of taxes, but also to develop the investment, to basically encourage the investment, to have the economic tie-up with the two countries. I think that is also very important. So if you read the Azadi Bachao Andolan Supreme Court judgment, the Supreme Court has interpreted that why India-Mauritius treaty has entered into, not only for the double tax avoidance purpose, but also to encourage the investment, to have the economic tie-up between the two countries. I think that is also very important. Whenever any treaty benefit has to be given, so objective of treaty is also very important. The other important is protocol. I think protocol is very important whenever, there is always addendum to that specific treaty. And in that addendum, like a supplementary to the treaty where they have defined or they give some example in understanding what you mean by that, the actual practical scenario they give. So if you see India-US treaty, and most of the case, you will see India-US treaty, the protocol is very important. Their concept of make available, non-make available, those type of concepts they explained by your protocol. So most favored nation clause, where India has entered into treaty with the USA or the France or Netherlands, where we have the protocol, where India is having any other country taxation, where the less tax basically rate or the scope of taxation also very reduced. The third country will also entitle. So third country, either who will be the OECD member country or the UN model country. Those basically countries, third party countries will also able to use the practical scenario, practical example given under the protocol. They will get the benefit of that. Foreign tax credit, we explain the exemption method, credit method, and India adopts ordinary credit method, where you will find that India, but we require to see that 40%. Now here I given that tax at the rate of 40% in the source country and tax at the rate of 20% in the source country. What will the tax implication? If you claim the full tax credit, full credit, irrespective of fact whether certain income only will be liable to tax, you will get entire credit. But in the ordinary credit, I think best example you will find in the first example is that 40% source country has a tax. So you have paid tax in the foreign country is at the rate of 40%. And suppose Indian resident having an income in India under the ordinary credit, under the first example, he has a 75,000 income, foreign based income 25,000, total income is 1 lakh. And suppose in India tax rate is 35%, then on because he is a resident of India, his global income will be liable to tax. Therefore, 35%, if you apply on 1 lakh, it comes to 35,000. And the foreign source of income, he paid 25,000 tax. Sorry, he earned 25,000 income. On that, 40% tax is paid. So around, basically, he paid 10,000 tax on 25,000 at the rate of 40%, whereas in India on 25,000, he is paying only 35% tax. So you require to see whether 8750 or 10,000, whichever is lower. So India will get only 8750 credit, because in India, he is paying less tax. Suppose he would have paid equivalent to 40% more tax, he would have entitled for the entire tax credit. But since the Indian tax rate or the residence tax rate is lower, then you will get a proportionate tax credit in the source country. This rule 128 of the income tax section 90 basically govern the provision of the foreign tax credit. So one can look at the important point, we need to understand that they have given specified what are the basically tax, if suppose the tax is deducted as per the domestic tax law, but under the DTA different tax rate is there, but for the purpose of FTC the DTA route would be applicable. This is a very important aspect, is that Form 67 you require to file along with the return of income in order to claim foreign tax credit. Of late we have seen that certain non-resident, certain resident who is having a foreign source of income, who suffered the foreign tax in those jurisdictions and claim the tax credit for in India. So in the return of income, they claim credit under the foreign tax credit for the foreign source of income, but they have not filed Form 67. The department has rejected their claim for FTC. So very important aspect is that Form 67 has to be filed along with the return of income. If you don't file FTC and if you claim in the return of income, you are not entitled for the credit. So this is a very important aspect one needs to see. Section 195, we already discussed that if any person responsible for making payment to non-resident and if the sum is chargeable to tax, then TDS provision will be applicable. We have two types of TDS provision. One under the domestic, that recipient is if Indian, then section 192, section 194, 194J, 194I, those payment will be applicable. But if the recipient is the non-resident, then section 195 would be applicable. 195 is not applicable to salary and certain types of interest income. One can see that also. At what rates you have to deduct tax at source under 195? Under 195, you have to deduct at the rate in force. Rate in force is defined under section 237A, and it is defined that it will be deducted as per the domestic tax law or the double tax ordinance, whichever is applicable, whichever is beneficial to him. This is very important aspect. And in order to claim DTA benefit, we discussed that he has to produce the tax residency certificate. If he doesn't apply the tax residency certificate, if he doesn't have the PAN number, then as per section 206AA, 20% or whichever is higher rate would be applicable. So these are the certain important aspect of section 206AA, which cases, you know, the higher tax rate would be applicable. I think one need to see, and this is a classical judgment in the case of this Kausalya by 346 ITR 156 206 applicable in all cases, because if you see section 195 is talking about if the sum is chargeable. If the sum is not chargeable in the hands of non-resident, section 195 would not trigger, section 206AA would not be triggered. But if the sum is chargeable in the hands of the non-resident, then section 206AA would be triggered. Then DD, this Serum Institute is Pune Tribunal judgment is very important, and they said whether section 206, because if you will see that under the double tax avoidance treaty, the rates given under the treaty, which is a basically bilateral, which is enforceable by the both country. But section 206AA amendment is a unilateral amendment. So whether bilateral treaty will override the unilateral amendment in the act, this has been explained in the Serum Institute. So one can see the decision of Serum Institute in those cases. We discussed that since 1991, our economy has opened up. Most of the multinationals started carrying out business in India. Based the concept of base erosion, profit shifting. There is a gaps and mismatches in the international tax rule, and that can make profit disappear in that entire process. And wherever multinational are shifting the profit from low tax jurisdiction, high tax jurisdiction to low tax jurisdiction, or without any paying, but they are doing a significant activity. So BEPS concept is that whenever the foreign company carrying out business in the source country, if the economic substantial activity is carrying out, the source country has a taxation right. So now the concept is that wherever the activity or economic activity is carried out, that country will have the right to tax. I think this is very important, that if you are Coca company, if you have opened a Coca company in one jurisdiction in order to claim the treaty benefit, and you are not carrying out, or you don't have substance in that intermediary jurisdiction, in that cases the department can disregard the treaty benefit if you are entitled for certain. So here, as I mentioned, there are 15 action plan has been issued under the BEPS, and so couple of BEPS action plan basically recommended under the Indian law. One is the CBC reporting. We are not going to touch upon today the transfer pricing. I may request the committee members that we can have a separate session on the transfer pricing, where master file or country by country reporting is also is amended under the Income Tax Act. If the multinational has more than 5,500 turnover globally, then you are required to comply with the CBC country by country reporting, where the tax authorities in India or foreign tax jurisdiction can exchange the information of transfer pricing with each other and basically see whether transfer pricing is properly applied or not. Master file is also very important. If you have more than 500 crore turnover, those cases master. So we used to maintain three basically documentation: local file, which is our normal transfer pricing form 3 CV; master file if your turnover is 500; and the country by country reporting, where my consolidated turnover of the global is more than 5,500 crore. Equalization levy, I think this is a new e-commerce taxation. You will find that is a new concept has brought, that in order now the business can be happen digitally with e-commerce platform. The foreigners is not required to have presence in the source country, and you can do online platform. So in those cases they brought the equalization levy where the source country have a right to pay, has the right to collect the tax from that foreign company, without having presence in the source country earn income substantially from using the digital platform or internet. Those type of levy is like a Google tax, is well known as a Google tax. Then tax regime for patents, GAR, general anti-avoidance rules regulation, multilateral instruments. These are the basically provisions under the income tax has been basically brought. So BEPS, as I mentioned, the equalization levy brought, but equalization levy is not levied under the Income Tax Act. It is levied under the Finance Act, and therefore they always tussle between the foreigner is that they are not entitled for the treatment benefit of foreign tax credit. The equalization levy, where you would get the foreign tax credit for the equalization levy. So there was always tussle between the US is lobbied heavily with the Indian tax authority that why you have put the equalization levy. So India is basically arguing that this equalization levy is not levied only for the USA, but all companies who are carrying out e-commerce transaction. And you will find that section 165 and section 165, which of the Finance Act deals with this equalization levy. So under the equalization levy, you will find that certain advertising income or certain e-commerce electronic facility platform, those type of income are get covered. So under the digital advertising space, or you are paying for some advertising services, then 2% equalization levy will be attracted. But there is an online sale of goods provision by the foreigner e-commerce who has e-commerce platform providing, those cases 6% levy. Of course, certain exemption, certain caveat has been given. So one needs to be very careful. And Finance Act 21, which has basically brought a retrospective amendment, that certain royalty and fees for technical services are not covered by the equalization levy. Those are basically covered by the royalty and fees for technical services under the Income Tax Act. Last year, Finance Act 2020 made amendment that if a particular sum is subject to tax under the equalization levy, then that will be tax exempt or tax free, exempted and in the hands of a non-resident for the purpose under Section 1050. But there was a basically dispute was arisen between that if a particular payment is also fees for technical royalty and equalization levy will attract, in those cases what will happen. So they clarified in Finance Act 2021 that if the payment are in the nature of royalty or fees for technical services, Section 916, Section 917 or TT provision will be applicable and not the equalization levy. So those cases will not get the benefit of Section 1050. But other cases where e-commerce supply, e-commerce services, if you are making a payment to a non-resident e-commerce operator for buying certain goods or buying certain services, or certain payment made to for the digital advertising like LinkedIn and or the other platform, you require to pay, those income will be exempt in the hands of non-resident Section 1050, but it will be subject to equalization levy at the rate of 6% or 2%. Place of effective management is a new concept basically brought under the statute in Finance Act 2015, where this concept has substituted the control and management of its affairs situated wholly in India in the case of company. Very important aspect of this circular, the circular 2017 has clarified that whether POEM would be triggered in all types of support services or where we carry out BPO types of services, whether those will be triggered because foreign companies carrying out BPO and they have outsourced certain BPO activity in India, whether foreign company would be regarded as a POEM or POEM, the place of basically where Indian company is carrying on business outside India, they set up a subsidiary outside India, but Indian subsidiary doesn't have presence and doesn't have active business. In that case, the foreign subsidiary's entire income would be liable to tax because that foreign subsidiary for the purpose of Section 66 regarded as a place of effective management in India because that company is basically controlled and managed by India. India is basically running the show of foreign company. The foreign company is just a coca company, doesn't have employees, doesn't have business, only for the purpose of certain passive income, earning income from royalty, earning income from trademark, interest, those cases. So those companies would also now be liable to tax in India by applying the POEM regulation. So they have given certain criteria for integrating the passive income. If it is more than 50%, then POEM would be triggered. If Indian assets are more than 50% of that foreign company, then the POEM would be triggered. If the foreigner's payroll is basically located, substantial payroll cost of that foreign company from the Indian employee, then the POEM would trigger. So these are basically the criteria they have considered for the purpose for considering the active business outside India. Last 3 years, of course, one of the important circular they have mentioned that if the gross total turnover or the gross receipt of that foreign company is less than 50 crore in particular financial year, then POEM would not trigger. So exemption has been given. So POEM is very draconian provision actually. One needs to, because right now you will find that certain Indian multinational has started providing, setting up the joint venture or the 100% subsidiary outside India for carrying out business outside India. But that foreign company is only paper company. The entire show or entire business of the foreign company is run by the Indian promoter or Indian holding company. In those cases, we need to be very careful while understanding the business. So we need to basically educate the Indian multinational. Otherwise, POEM would applicable. Whatever the profit earned by the foreign company would also be taxable because the residential status of that foreign company become a resident status. So these are the very important aspect, and in that case, foreign company will be liable to tax on the foreign income. Same time, although the residential status would be regarded as a resident, but you will still be liable to tax at the rate of 40% because you are a foreign company. So you won't get a benefit of 22 or 30%. That tax rate is which is applicable to the local domestic company. So one needs to be very careful in basically arranging the affairs of this foreign company. Then we have brought the thin capitalization regulation under the TP regulation, very important aspect. general anti-avoidance rule, that any impermissible avoidance arrangement, the main purpose is to tax benefit will be disregarded, and whatever the tax benefit advantage you will get or transfer pricing would be applicable in those cases, or the transaction doesn't have commercial substance, it is just on paper transaction, those transactions will be disregarded. Country by country we just discuss. MLI also we discussed that normally under section 90 of the Income Tax Act, whenever we examine the taxability of a non-resident, because of section 90 we have two options. You can understand the tax implication under the Income Tax Act or double tax avoidance treaty, whichever is beneficial to him. But now the MLI is a new instrument which has brought, where you require to see treaty implication, you require to see the Income Tax Act implication, and also you require to see the MLI. Now multilateral instrument will apply alongside the DTA provision, either supplement or complement. So not only the basic provision of the treaty, but certain amendment because of MLI has been done. Because now India must have understood, you will see the India-Mauritius Treaty, they brought the certain regulation under the India-Mauritius Treaty. You will not get now the capital gain tax exemption. So they brought the concept that the Mauritius entity should have minimum this much expenditure. It should have minimum holding, or you should be in the business for last couple of years. So all those substance has been created. So the MLI basically brought that whenever non-resident taxation is considered, you required to see Income Tax Act, you required to see the basic provisions of DTA, and also you required to see what are the changes made by the MLI, multilateral instrument. So this is a very important aspect, and therefore you will find that whenever we are issuing, and now you will see as on 15 January 21, there are 93 countries have signed the multilateral instrument. So the government is not required to enter separately MLI with each country. It will be applicable. It's a standard, basically the document which is minimum standard has to be applied to the all countries. So by depositing certain MLI, you will become automatically member of this MLI, and you have signed by signing. So these are the basically the India has started, and you will find that there are three types of treaty you will find. One is a limited treaty, comprehensive treaty, which you examine. Now there is a synthesized version of treaty. Synthesized version of treaty where the MLA has been invoked. Those MLA has been forced into operation, and therefore whenever you are examining the non-resident taxation, you require to consider those changes of multilateral instrument also while examining the tax implication. Certain exemption of income, I think these provisions you can read anytime. Certain non-residents are not liable to tax in India on certain income, so section 10 provides. Following transaction would not be regarded as a transfer for the purpose of section 45. So you may consider like gift, will, or irrevocable trust, or family partition of HUF. Section 56 to 10, if there is a gift happen or certain transaction happen with the relatives, and certain relatives are non-resident, certain relatives are resident, then those benefit also they will get benefit out of that. Section 54, 54 EC, 54 GB, 54F, reinvestment of capital gain is also applicable to the non-resident one. So one may consider those basically benefit. Constitutional rate of taxes are there. Just wanted to highlight section 115, which deals about the taxation of FTAs, taxation of royalty, taxation of interest, and the Finance Act 2021 has made amendments that if a non-resident is liable to tax as per section 115A, then they don't require to file return of income. Now this exemption of filing of return, earlier it was given only for the interest and dividend. Now it has been extended to even fees for technical services royalty. So if the foreigner has earned fees for technical services royalty and 10% rate plus surcharge is applicable as per 115 on withholding tax, the exemption has been given to them that they don't require to file any return of income for fees for technical. If you have other source of income, then you require to file income even for the royalty. But your income is only for royalty and fees for technical services and taxes deducted as per 115, then you don't require to file the return of income. There is a special regime for the non-resident 115. I think this series is very important. One can see the long-term capital gains are taxable at 10 or 20% as the KME. Interest will be taxable as per the normal tax rate. Certain specified assets like that convertible foreign exchange, the investment made in shares or debentures, or if you have kept certain depository in NR account in India, those exemption will be the non-residents are basically getting. The exemption has been given to the non-resident Indian also not to file return of income if the tax has been deducted by applying this 1 month. So 115G is also very important. Section 115H is also very important, that once a non-resident will become a resident. So whether that benefit avail under this regime, chapter this 12A, this regime, whether they are entitled for the regime or not. So they have clarified that till the maturity of that investment, you will still be governed by the, even if you become a resident under the Income Tax Act. So 115H is very important from that perspective. I think, as I mentioned to you, each topic itself would take more than 2 hours for each topic, but I tried to summarize given the overview. In this topic, this presentation, I not covered the transfer pricing in detail and the Black Money Act. I think we'll require to have a separate session, but I believe that most of the students must have got the idea about the taxation, very interesting subject, emerging area. From the career perspective, I would say the very important this thing, if you want to go in the MNCs, multinational companies, you will have the opportunity in working for the double taxation. If you are working in the big charter accountant firms, where you will get the exposure of the double tax avoidance, foreign taxation, because the bigger consultancy charter accountant firms have the separate cell for the foreign taxation, separate cell for the transfer pricing, separate cell for merger and acquisition. You will have a lot of opportunity. Forget about the big consultancy firm or the multinational company, even small charter accountant firm also, because nowadays, because you will find that local small businesses or even the resident persons also started making remittance outside India. So you require Form 15CB, you require to file their return of income. So this taxation is very important. As I mentioned to you, in order to practice the international tax, you don't have to master only on the double tax treaty, be MLI or the BEPS action plan, but also you have to master on Section 4, Section 5, Section 90, Section 9, Section 15. All those series are very important. So thank you, students, for patience hearing. I will hand over the webinar to the organizer. Thank you.
Shivam, are you there?
If anyone has a question or anything, I'm happy to provide how much time we have. But otherwise, I believe that you will be sharing this presentation slide to all students.
Yes, definitely, sir. Thank you so much. I
Shivam,
think
if any question, just look it up.
Shivam, sir,
No,
I
no,
think he.
no issues. You can just check if any questions are there on YouTube or either of it, so that sir can just adhere, and probably there shouldn't be any question because the slides were so much explanatory and so much well versed. Rather thought of it because I remember very well when we were in Garud Machi, sir had given this session, and the session was for 2 hours, but sir took almost 4 hours. And literally, I will tell you the knowledge of sir is so much that he likes to impart so much that he doesn't keep even a single thing to just convey to the listeners. Means just you take away how much you can. It is our ते बोलतात ना मराठीमध्ये म्हण आहे की झुबळी तू आमची फाटकी. Okay, that much big, how much we can just carry in our bags and pockets, we can just carry. So this is what the knowledge and ambit of and lucidity of sir is when it comes to session. Means we really think that I couldn't just get up even for a single minute when sir was just listening. And this is second time this occasion happened that I could just listen to sir and would able to grab as much as possible. Rather, some of the slides I very well remember that the slide for I'll just try to share one of the slides. Is my screen visible?
No, sir, not yet.
No,
Not yet.
Not yet, sir.
Fine, chalo. I'll just if not possible now, I'll see the chart which sir prepared for less than 100 days. If it is, then if it is more than 1 day, then yes, then he is resident, and then no, he has to go down. We have to check the 60 days thing within and or 365 days in preceding 4 years. This sheet was sir has prepared now. I have taken the screenshot of it because that is so much easy application when it comes. You really just we have to put in the chart and we have to see how the application is, how easily it happens. Come down, come down, come down, come down. Yes, this sheet. This sheet I was friends I was trying to discuss. This chart is so much useful that the application of non-resident resident becomes so much easy for me to understand and explain the condition accordingly and accordingly decide the taxation, whether he is resident, whether he is not resident, not ordinary resident or ordinary resident. Accordingly, it becomes very easy and simplified when we want to give any consultancy. So how this small and in that again the condition which is added for this 15 lakh if it is which is introduced this year only. So all the smallest of the small and the two case laws. One case law which sir said about sorry, I just missed this thing. Yes, Azadi Bachao Andolan. So yes, exactly. So this just I'm trying to just make a quick review of all these aspects. Means how easy if you just listen to this all these talks what sir has done, it becomes so easy to just mesmerize when you have to practically apply it anywhere any point of time. So that is the best part of sir when it comes to deliver any of the lectures or sessions any point of time. So I sir insisted sir that please give because what happens in Thane this is very difficult to get such kind of practice. Okay, but then at Thane at least people understand what this Indian taxation is about because many times people ask, "Ki, we want knowledge there, but we are not able to get it out. How to go it out? How to gain that? How to understand?" So sir delivering the same and people like us understanding listening to us is very beautiful for we guys to whether we can go and have this kind of practice in future. So once again Rajesh sir, we would like to Thane Vikasa would like to thank you from bottom of our heart for delivering such a beautiful session. And Smriti, are there any queries on YouTube?
I just wanted to add here, Rahul, for all students, because all students
Yes,
are
sir.
basically subscribed the Charter Accountant Students Journal.
Oh,
And December 2020 journal is very important because they have brought certain, the certain this thing, section of that journal is on international taxation and nicely explained by way of
which
charts.
journal sir you said?
December 20, December 20 journal of student journal of institute.
of insured. Okay. Okay.
They have summarized international taxation in 5-6 pages in the table format.
Okay.
I think very nicely
Very nice.
explained actually.
Very nice. So, Smriti, you can go ahead.
So there are no queries on YouTube,
No
but
queries, no? Fine, then we can just
section
go ahead.
achievement, knowledge. And I would also like to thank you, Rahul sir, for this amazing.
Smriti, we are not able to hear you.
Events you wanted
Smriti,
to
we are not
cover.
able to hear you out. Could you just say it again, because we all were not able to hear you out.
Am I audible?
Yeah, you're
Yes,
audible.
yes.
Just check
Yeah,
your
so
network properly. Like, is your network doing good?
yes, I am connected to the Wi-Fi.
Okay,
Okay.
fantastic.
So first of all, I would like to thank
No, Smriti,
shared with
not
us
able to
today.
hear you out.
Not able to hear you, Smriti.
I think there is some connectivity issue.
Okay, I think someone else can go ahead and give the vote of thanks to the speaker, I believe, because there's some issue on my end.
Smriti, I'll take in charge. That's not an issue. So,
Yes, Shivam, go ahead.
thank you so much, Rahul sir. I, on behalf of Thane Vikasa, would like to present a heartiest vote of thanks to Rajesh Athavale sir for presenting his views and sharing his insights on the topic of international taxation. Thank you so much, sir, for sparing some time out and coming on Thane Vikasa's YouTube channel. I hope you love the audience response over here, and we hope to see you someday soon again.
Thank you very much, Rahul and the entire Vikasa team for giving me this opportunity. Because apart from this lecture, I shall be happy to share the other knowledge which can be beneficial to the student. Because of course, income tax law or the international tax, I'm practicing every day. But to give the correct background, correct foundation to the student, I almost working very hard for 3-4 days to give that correct knowledge has to be passed on to the student. See, it is different thing that I'm giving a lecture or the way sharing my thoughts to the webinar to the professional people. But the students who are basically going to be the professional of the future, they should have the fundamental knowledge, and they should have the incline to grab the new opportunity, new emerging area. And this is what I thought that, and that's why I spent time basically to that. I should give the proper knowledge, proper foundation to the student, so it will be easy for them to take this as the career, one of the career path going ahead. Thanks, Rahul, for giving this opportunity.
Thank you, sir. Thank you, sir. Thank you, sir. Thank you, friends. Chalte, I would like to say some alphas, because I got some message from Shivam, so I thought I'd like to just some things for Thane Vikasa. अल्फाज जो कभी भूल ना सको, हर पल याद आएंगे वो पल, जो दिल के करीब हमेशा रखो, जिंदगी में यही ख्वाहिश रखो कि किसी मोड़ पे फिर आप सबसे मिल सको. Thank you, friends.
Thank you.
Thank you so much, sir.
Thank you so much, sir.
Bye-bye.
Sir, I'll end this session.